What if your mortgage went from 2% to 5%? This video is going to show you why, in simple terms, and what you can actually do about it. Through this video, I'm going to use 3 layers. Layer 1 are big forces, stuff none of us can control. Layer 2 are lenders' choices. This is how banks can price their deals. And layer 3, the most important one, are your choices. These are things that you can do and tweak. Stay to the end to fully understand what you can do to get the best deal possible. Layer 1, understanding things that we can't control. When inflation is high, the value of money is less. To cool things down, the Bank of England usually raises the base rate. That makes borrowing pricier, including mortgages. So think of the base rate like the UK's starting price for money. When it goes up, lots of borrowing gets more expensive. Your mortgage rate doesn't copy it exactly, but it does get influenced by it. To give a bit of context, the base rate is what the banks pay or charge each other at the core of most transactions. Number 3, markets, particularly the swap markets and gilts market. In simple terms, the banks and these markets try to guess the future. If traders think that future rates will be higher, then swap rates go up. And this then has a knock-on effect to the lender's costs to offer fixed-rate mortgages, which also rise. Gilts, the government IOUs, work similarly. If gilt yields rises, it's a sign the money's getting more expensive. 4, global shocks. You've got to think here, things like oil price increases, wars, pandemics. Big events can make lenders extremely nervous. And nervous markets equals a higher safety net for all lenders. And this ultimately pushes rates up. 5, funding costs and margins. In order to lend you money for your mortgage, banks need to buy money before they can actually lend it to you. So if the ability for them to buy this money gets more expensive, then your rate will reflect that and will increase too. And they also add a margin to make sure they stay profitable too and cover any risk. 6, risk and rules. If there are strict rules from the FCA to say that banks have to hold more capital for certain loans, or if the economy looks shaky, lenders price in more caution, so more risk equals higher rates. Number 7, competition and capacity. So more active lenders equals more competition. More competition often leads to more keen pricing. Fewer lenders or busier lenders can often mean higher rates so they can manage their workload. Product features and costs. Some products have extras. For example, some are fee-free, some have longer fixed periods, or flexible features. If it costs the lender more to offer them, then the rate can often be higher. Layer 2, lender decisions. So in order to lend you the money to buy your home or remortgage your home, banks first need to go and accumulate that money, and they typically have to go and buy it. So before they lend it to you, if the amount of money they have to pay for that money gets more expensive, then your rate will often go up in line with that. And they also, on top of that, add a margin to make sure that they maintain profitability, but also cover their own risk. Number 6, risk and rules. If rules say hold more capital for certain types of loans, or if the economy looks a bit shakier, lenders can price in much more caution. More risk always equals higher rate. Competition and capacity. If there are more lenders in the market, that usually equals more competition. More competition equals better pricing. Fewer lenders or busier lenders can often mean higher rates whilst they try to catch up and almost de-incentivize people whilst they catch up with their workload. Product features and costs. Some products have extras. Some are fee-free. Some have longer or shorter fixed-rate periods. There are other flexible features such as portability. If it costs more for the lender to offer them, then the rate can often be higher. Layer 3, your choices. The things you control, the really big wins. Loan to value. Now this is the amount you're borrowing compared to the property value. The smaller the deposit, usually the higher the rate. If you can lower your loan to value, even by a little, you may just unlock better pricing. Your personal credit score. Making sure you're paying your commitments on time, avoid maxing out your credit cards, keep your bank statements tidy, equals making lenders feel much safer to lend. Term and type. 2 years versus 5 years, or a variable. There's a trade-off. Shorter fixes react faster to markets. Longer fixes can give peace of mind, but can be higher. Fees versus rate. Sometimes paying a fee gets a lower rate. Make sure you do your maths. It's not always worth it. Timing. Don't wait. You can start 6 to 7 months before your fixed rate ends. Many lenders let you lock in a deal at least 6 months before. Then switch if a better one appears. Always lock early, review later.